The vast majority of investors are apparently clueless to the current situation. During this market crash, they haven't bothered to scratch the surface to see the massive rotation taking place, the complete change in the investing landscape due to the onset of inflation. When the Fed stops pumping money into the economy, the dynamics that have been in place for investors over the past decade will shift dramatically, regardless of the Fed's best efforts to the contrary. The bubble has been popped, and we don't see any way to stop the inevitable deflation at this point. On the other hand, this is Investing Path, and let's delve deeper into this matter for today's video. But before we jump in, make sure to give this video a like and subscribe, and might as well hit the bell button to see more of our content. First, let's talk about inflation, the first half of the stagflation equation, because it is quite evident that we have a serious inflation problem and have done so for more than a decade. Yet, because inflation has been driving up asset values rather than customer price indices, it hasn't shown up in a way that's been an issue for the Fed or investors. Consumer prices rose, but not by a worrying amount since the government hid the true extent of price increases by using the Consumer Price Index, which doesn't do a very good job. By intention of representing the true state of the market, we believe. With the government able to claim inflation was below 2%, the Fed was able to continue its inflationary policies of QE, stimulus, and 0% interest rates with impunity. The majority of the influx of capital went into the financial sector, but it has also contributed to the largest trade deficit in American history. In fact, we learned that December's trade imbalance was a record-breaking $101 billion, the first time that the deficit had been above $100 billion in a single month. The general level rose by 7%. The Consumer Price Index would have been even higher if our trading partners hadn't dumped $1 trillion worth of goods on the market. How exactly did we manage to cover the cost of all of this? To be honest, we didn't. America spent a lot of money that they didn't earn in the items that were manufactured in other countries because we printed money and exchanged it for those goods. When we initially entered the pandemic in March of 2020, we implemented the worst conceivable monetary and fiscal policy combination as the economy was closing down owing to COVID and due to government restrictions as a result of COVID. The government and the Fed connived for the worst combination of monetary and fiscal policy possibly in the history of the United States. Instead of doing the proper thing and shrinking money supply together with the economy, so demand would go down with supply. In other words, it is a natural result of being unable to fulfill one's potential. If you don't have anything, you're going to run out of it. But the government and the Federal Reserve caused an unprecedented surge in demand, and we're only now starting to suffer the effects of that inflation. We believe that the bulk of the inflation we have experienced in 2021 was a lingering effect of inflationary policies implemented before 2020. Many people working at the Fed probably didn't believe those lies, but they uttered them nevertheless to appease the markets. They didn't want the market to panic, and we believe that's largely what they were doing here. They were avoiding informing the markets of just how severe inflation was going to get. In order to maintain the illusion that everything was well, they simply said it was temporary. It is too late to do anything about the inflation, which it now concedes wasn't temporary. If you want to solve the inflation problem, you can do so by adding fuel to the fire. Still, a stimulative interest rate, but now, it's an aggressive tightening that will take care of the worst inflation in 40 years. In truth, it is the worst inflation ever, because 40 years ago, we were measuring inflation with a very different CPI than we are now. If we were to compare the Consumer Price Index from this year with the CPI from 40 years ago, using the same CPI that was being utilized, we would find that the consumer prices increased by roughly 15% in 2021, which would be more than any year in the 1970s. In fact, it would be greater in the year 1980, which had been the all-time high for the CPI until last year, when it peaked at 13.5%. But how did we put out the inflation fire in 1980? With interest rates at 20%. Thanks to Paul Volcker, we had a real rate of interest of 6.5%, which was a great incentive to hold on to US dollars and save money. Yes, it is more expensive than it was before, but if inflation accelerates as expected, real interest rates will decline even as Fed raises them slightly. This is making the inflation situation worse. But here's the bigger problem. They're pursuing a more stimulative policy while appearing to tighten. The Federal Reserve said that the lack of inflation justified their policy of artificially low interest rates and quantitative easing. When inflation is 3 times or more than 2%, the Federal Reserve can no longer rationally justify keeping interest rates at artificially low levels, since even a 2% increase would still leave rates at unnaturally low levels. Since our massive debt bubble was the only thing keeping us afloat, the Federal Reserve was forced to keep interest rates artificially low. Allowing interest rates to return to normal would cause the financial catastrophe even more severe. No matter which option you pick, it will be a horrible one. The worst option is to do nothing about inflation, which will cause interest rates to rise and the economy to collapse. However, they are likely to choose the worst option possible and keep pumping money into the economy, delaying the inevitable effects of the hyperinflation for as long as possible. Just by the Fed talking about it, the bubble is beginning to deflate. They're going to keep sliding down. As we speak, global markets show mixed results, with foreign markets generally up when looking at value stocks and the Nasdaq down by approximately 14%. Because there is currently zero momentum. They can put their money in cash because inflation will eat away at its value. And they can put in the bonds because of the same inflation problem. Only worse, because they can't get their cash until the bonds mature and could take a huge loss on the bonds if they want to sell early in the long-term interest rates rise. What other options do you have besides selling your overvalued American stocks? Investing in cheap overseas equities is a must, as doing so serves 2 purposes. You sell your US stock holdings and reinvest the proceeds in more attractively valued, profitable companies. Get out of the US dollar now because it will collapse when people realize the Fed can stop inflation, and that inflation will continue to take away the value of the dollar in the future. Even if you are making money, making things, selling things, generating revenues, and paying dividends. Inflation is the underlying cause of this recession because it will raise the cost of living to such an extent that the average American will have to spend a disproportionately large amount of their discretionary income on necessities like food, energy, housing, insurance, and medical care. They won't be able to afford discretionary purchases, and that will put individuals out of work who make their living in the sector of the economy that benefits from such purchases. Your best bet is to invest in things like gold and silver as a hedge against inflation and get out of the US dollar. Without a doubt, things will be much more dire this time around. Unfortunately, unlike in 1980, when we were still a wealthy creditor nation, we will not be able to raise interest rates to combat the worsening inflation and sputtering economy that would result from this situation, now that the government is entirely insolvent. Since our debt was low in comparison to our GDP, we were nonetheless required to run trade surpluses, the opposite of what's happening in the United States right now, so we shouldn't expect a happy ending. Instead, we should prepare for something much worse, and that includes making sure your portfolio is stagflation-proof, as this could lead to a depression rather than just a recession, and inflation could even reach hyperinflationary levels. So, you're also keen on investing in the shares of foreign companies. For the most part, we agree that the dividend-paying foreign stocks should make up the bulk of a diversified international investment portfolio, but if you have other thoughts in mind, then feel free to share them in the comment section below and see what others have to say as well. Other than that, we thank you so much for watching. This is Investing Path. If you liked this video, please don't hesitate to give this video a thumbs up and hit the subscribe and bell button as well to stay updated for more of our personal financing and investment uploads. Thanks again for watching, and we'll see you soon.